Hello there, and welcome to our latest episode of the Market Misbehavior podcast. My name is Dave Keller. I'm the founder of Market Misbehavior. I can't thank you enough for joining me on our podcast as we sit down with top market practitioners, investors, strategists, authors, educators, anyone else we can put a microphone in front of to talk about market dynamics, to talk about market history, to learn some of their lessons learned or review some of their lessons learned over successful careers in the financial industry, and get a sense of where they are focusing, what sort of opportunities they are identifying in the current market environment. Today I have a really fun interview to share with you. Jay Soloff. Jay's the lead options analyst at Investors Alley. He has a number of roles that he plays, but he's really an educator in the options space. What you'll learn from my conversation with Jay, he actually got his start at the Kansas City Board of Trade in the futures market, and then transitioned up to Chicago, where he became a market maker in the options markets there. After that, we talk about the VIX, and really we spend most of our time talking about volatility. I was chatting with Jay before we started. He said, I'd really love to sort of dispel some myths about volatility. I feel like that's an area where a lot of investors really don't understand enough. And I want to kind of focus there. And I thought that was a lot of fun to explore the VIX, why the VIX level of 20 is important. He actually shared why the VIX level of 16 is important, which actually was a really important thing to understand in terms of what the VIX is actually telling us about expectations for the S&P 500, because it's a measure of implied volatility. It's implying what the volatility of the S&P would most likely be. We talked a lot about term structure, and this is talking about the VIX futures market, sort of the forward-looking lens with which investors can understand the VIX and how that term structure has changed just in the last couple weeks. Finally, I asked him about zero DTE or 0 days to expiration options, and I really appreciated being able to ask someone like him about the potential impact of this relatively new but what has become the most heavily traded area of the options market, certainly for retail investors. So please enjoy this recent conversation I had with Jay Soloff, the lead options analyst at Investors Alley. Super excited to be sitting down today with Jay Soloff. Jay's the lead options analyst at Investors Alley. Jay, it's been a pleasure to interview you a number of times over the years, but especially now, I feel like plenty to talk about. So before we get started, how are things on your side? You doing all right these days?
Yeah, thanks, David. It's always great to be here. I know feels like it's been 3-4 years now, that maybe more, that we've been doing this. So
Yeah.
It's time flies. But yeah, it's definitely been exciting. Certainly the markets are keeping us on our toes lately.
I feel when we were talking before we got started, I feel like there's plenty going on here. I think we could all use a break of some sort, but I don't know if we'll see how that plays out over the next 20 minutes or so. But I don't know if a break is in the cards for either of us here in the short term. But we'll see. So Jay, before we get to the charts, and you brought some really good charts about volatility, which I think is so important because the VIX is now really changed from where it was last year to now 2025. So I really want to dig into that. But before we do that, give us a little bit of the Jay Soloff origin story. I think you started as a market maker, right? I want to say like CBOE
Yep.
or CBO, right?
Yeah, that's exactly. Yeah, exactly.
Talk to us about those sort of formative years. When was that? What sort of, what were those early experiences that shaped, I guess, the trader, the analyst that you are today?
Yeah, absolutely. So I'm from Kansas City. So I actually started at the Kansas City Board of Trade when they had a
Nice.
floor. Basically, they only traded wheat. Well, they traded a couple things. Value Line, which was actually the first stock index, but it got eclipsed pretty quickly by the S&P 500 or S&P 100, whatever was around at that time. And
Yeah.
but it was big for wheat, and I worked for the exchange, so really it was just kind of like reporting prices, but that got me interested in the derivative side of things. My background was economics, and I was just interested in all that stuff. But everyone on the floor there said, if you want to trade, you should trade options. That's where all the action is going to be, and if you need to do that, you should go to Chicago. And like I had gone to University of Illinois, so I already had I had a lot of contacts up there already. So just to speed it up, I ended up becoming a market maker on the options exchange on the CBOE there after clerking in the S&P 500 pit. So kind of learning really about just equity trading, equity option trading. I went into single stocks like Amazon, and WorldCom was a big one at the time. course, doesn't exist anymore.
Wow.
But what I really learned, which is interesting. Actually, a lot of the stuff in that in my pit that I worked in doesn't exist. It was either got gobbled up by another. A lot of them merged. Like Gillette was its own company, and I think it's like Procter
Sure.
stuff like that. But WorldCom was obviously a little bit more colorful experience. But
right.
What I really learned down there was that what professional traders look at is volatility. So that's what really shaped everything I've done from that, and I've done a bunch of stuff after, since then. I've got I went to get an MBA and I tried my hand at more corporate finance and hedge fund type stuff. But I really like options was what I would always come back to because I just really enjoy it. And, now mostly I'm more on the teaching side of things and just, newsletters, webinars, teaching but I try to really focus on the volatility aspect because that is what I think separates like the next level of option traders from people who are just like, oh, it's a leveraged way to trade directionally, right? Like that's how I think most people get into it. And you realize after a while that, your edge is on the volatility side. So that tends to be my focus.
It's so interesting because I know in my I guess maybe ignorant early days of learning about the financial markets, this is like early 2000s for me. And I remember meeting with options traders, and I was laughing that they basically were looking at a big table of numbers essentially and thinking about volatilities, looking at all the Greeks. And I'm more of a visual guy, so I'm thinking charts and it's all about picking the levels. And they would do that, but it was really more about volatility. I mean, at the end of the day, they were just looking at different ways of thinking about shifts in volatility. So you made a really good point, which is I feel like a lot of people, early on, they think of options as a kind of leveraged way to make a directional bet, right? So I can, or a lower cost way to do it. But can you talk a little bit more about why volatility is so important, right? Why, as an options trader, is volatility so essential for identifying opportunities in the options market?
Yeah, absolutely. And I think this is, very, very much a misunderstood point, right? That, and I'm not saying, options, if you're an excellent directional trader and you can utilize options to, increase your profits, great. Like I'm not good at that, right? Directional trading is really hard for me. But like my general thought is that if you're really good at picking direction, trade a stock, trade a futures, right? Why give yourself a time limit, which options obviously you can do 2-year out options and then it's similar to more of a stock or a future or whatever. But I mean, if you're doing short-term options and you're giving yourself that time limit, why do that? If you're a good directional trader, there's other ways you can do that. Why put yourself at a disadvantage where the clock is ticking on the option and it's slowly losing value over time? To me, like, you want to try to take advantage of the inherent definition of an option, which is a short-term contract. And that is, the pricing is so much related to volatility. So your edge, really, your long-term edge, is understanding if an option is cheap or expensive. And again, like I'm sure there's plenty of people who can use options directionally and do really well. I'm not one of them. So I've never really tried to say, oh, hey, I mean, maybe in my retirement account, I'll buy a long-term option.
Sure.
Just to keep my capital, like my Roth IRA, I have a limited amount of capital. So, okay, I have a directional opinion. I might buy a long-term option. I know what edge I'm giving up. It's just, it's one of those situations. But for the most part, like, I mean, like, if you ever look at a hedge fund that trades options, their focus is going to be on volatility, relative volatility, some kind of thing, that they're not doing directional trades, maybe a small portion of some portfolio, but they're doing other stuff, maybe to accentuate a stock return or something like that. So
right. And one of the things I've learned from, and again, I don't trade options a lot myself, but I've worked with a number of people and talked with people like you it's so helpful to just understand this different market and how it's structured and what the challenges and benefits are. But I know, like, certainly there are a lot of things, like stocks like Intel right now are just kind of dead sideways. They're kind of these choppy sideways markets. And if all you're doing is kind of plain vanilla long short stocks, you kind of just have to wait. You just have to wait for an opportunity. But with options, you have ways to bet on pretty much anything, right? A sideways market could be super profitable if you have the right structure on and you kind of
Absolutely.
go about it. So no, well said. I appreciate you talking through that. Let's get through some of the charts here, Jay, because you sent some charts of the VIX, and volatility has certainly changed, right? I mean, I think when you kind of like late 23 to 24, the VIX kind of in the low mid teens a lot of the time. All of a sudden, in the last like 6 to 8 months, we saw the huge spike in the VIX, kind of last summer, July, August. And then we've kind of remained in this elevated sort of volatility phase. So here's a chart of the VIX that you shared. Talk us through the conditions of the VIX. What does this tell us here?
Yeah, so the VIX also, VIX is it's been nice to see for me. Like the VIX was this thing that we talked about on the floor in the late 90s that even traders on the floor, even not all the traders on the floor were necessarily talking about it then, right? It was just starting to get traction. Now it's like, you might see it in the same page that you see what the Dow is doing, what the NASDAQ is doing. You see what the VIX is doing. It's become really popular.
This is front page news now, Jay.
It's
okay, this is above
news.
the fold.
But I don't think necessarily a lot of people, which I'm really happy about because I think it's super useful, but I don't know necessarily if a lot of people really understand. Just they understand that going higher means more volatility. And, obviously it's been labeled the fear index. So showing more fear. And I think that's actually a pretty good way to describe it. I think that, a lot of people don't realize. So one way to interpret it is that for every 16 whatever dollars levels, whatever, like this, the number 16 is important. That basically equates to the market expecting 1% moves per day. In this case, in the S&P 500. So when we're at 16, we would expect around a 1% move today, which actually, per day, which is actually, more than what's normal during regular times. Right. We saw for a while there, we were seeing like close to 2% move. So you would expect the VIX to be over 30 in that. And we really just barely touched that. So it doesn't, you're going to have that environment for a while if you want to see the VIX stay up above 30. So, that's one good way of looking at it, but really it's based on option pricing. So when people buy more options, particularly on the put side, when it comes to indexes, it's a supply demand thing, right? You buy more options, the price goes up. That means implied volatility is going up. And that's what this measures. And so generally when you're seeing option buying in an index, it's hedging. People are buying puts. You see a lot more put buying than call buying normally in an index, right? Over time. And people buy puts to hedge because they're worried about the downside. So as people buy more puts, the price of puts go up, implied volatility goes up. That goes into this VIX calculation, and you see VIX go up. So that is, a pretty good sign that people are scared. Like hedging is expensive. People aren't going to do it. Investors, portfolio managers, whoever is buying these, they're not going to do it unless they're worried, because puts are particularly when people are worried, puts are expensive, right? So I think it's a really good, and it generally starts to happen before any event happens. People start worrying about the next Fed meeting. You start seeing VIX go up because people are buying puts, right? If they're not worried about the Fed meeting, the level won't change. So it's a pretty good early warning indicator. And also maybe a regime indicator, right? When you're above, let's say 20 is kind of the long-term average, although 15, 16 is more the long-term median, because obviously like you see in August, you have these really high results that can skew that. But if you look at the long-term average, 20 is a pretty good level where people are saying, okay, I'm worried that, something could happen and the market's going to tank 5% in a day or something like that. So that's really kind of also a nice regime indicator saying, maybe I need to start being more conservative with my investments, or put some in cash, or put some in bonds, or whatever people do to protect themselves.
Right. Interesting. Okay, so the VIX is showing us sort of this, level of fear, I guess, or level of implied volatility. Talk to us a little bit about the term structure in the VIX. And I would say this is something we've not talked a lot about on the show before. So I'm very curious. The term structure appears to have changed a bit here. Talk us through what this is, this is telling us about the current conditions here.
Yeah, absolutely. And I didn't mention so the VIX had dropped. So I had brought up the chart and I talked about the VIX and nothing about the chart. But what it was showing is that we have dropped from the highest levels back down to under 20.
Yeah.
Looks like right. Yeah. As when I got this chart, we were just back under 20 for the first time since a lot of this tariff stuff started. So that's one sign that maybe it's still high relative to historical levels, right? Right exit right at the long term average, but it
Right.
has settled in a bit, compared to obviously where we were. So maybe the market's internalizing the tariff stuff a little bit. Hard to say. So then I said, okay, well, we can look at that a little bit further because the VIX itself is just a calculation. It's
Sure.
technically speaking, it's a variance swap calculation, which is a professional sort of contract that even I've never touched in my life. But it's a good way to calculate sort of volatility that's not related to anything else. So, but you can't
Okay.
trade it. So the one thing you can trade then is futures or options on futures or ETFs. But the ETFs are all based on the futures. So then that's where the term structure comes in. And if you've ever traded futures, then people who trade futures are generally aware of the term structure, right? It shows every future out through whatever, a year, 6 months, whatever it might be. And in basically in plain English, when you have your front month, in this case it was March, much higher than everything else, um, that is the month that everyone's focusing on. And in the case of VIX, that means that's the month that everyone's scared, right? Like people are really
Right.
worried if our front month is close to 30 and the back month out there is close to whatever 24, then
Right.
clearly people are more concerned about the present than the future. And so when you see an inverted curve like this, think, inverted treasury yield, everyone's got these things. Oh, the curve's inverted, right? And you need to worry. Well, that's very true with the VIX. In this state, which we call backwardation, it really means people are very worried. So this is from March 10th. So not that long. So 10 days ago, right? But this is when the market was really getting hammered pretty hard, particularly tech.
Got it. So to recap, this is looking at the VIX futures, right? So related to derived from the VIX index. But this is now we have futures, which means we have a term structure. We can look at expirations going out, month over month. And so the high reading or the high level of the futures on the March contract, and this is a week and a half, 2 weeks ago, way elevated compared to further down. So that implies a lot of uncertainty or elevated anxiety about the current market conditions. Is that fair?
Yeah, absolutely. I
Yeah,
think
okay.
there's an interesting difference between risk and uncertainty that again is not something
Sure.
that most traders realize, and your risk can be measured, right? And
Yeah.
that's what I was talking about. Okay, every 16 points in the VIX, you kind of expect a 1% move per day. That's
Yeah.
measurable. Obviously, it's not. It's an estimate. It's a probability, but it's measurable. When you see a curve like this, what we're looking at here, that means people are uncertain, and
Mm,
uncertainty can't be measured, and that's when you have like the craziest stuff happen, right? Because no
yeah.
one knows how to react because it's not a situation they're familiar with. So you can't really measure your risk. So I think this is kind of showing that. And again, it was only 10 days ago, right?
Yeah. So speaking of which, so the world has fluctuated a bit here. So this is probably earlier this week, I'm guessing.
Yeah,
Today we're
this is
recording
actually
this on March
today.
20th.
Yeah, this is
Okay. So this is
yeah.
this is now March 20th. So change in the shape of the term structure. What does that mean?
So, and it's a little somewhat hard to see because it's zoomed in, which is the only way I could show it. But
Yeah.
this is actually a pretty flat curve from, around 20 to, it's not even 20 to 22. It's probably
Yeah.
somewhere less than 2 points. If you were to zoom out, it would almost look like a flat line. But you could
Yeah.
certainly
Okay.
see that the front month future is lower than the back month future. So
Yep.
while the overall level is still elevated, right? We're still around 20 again, which is kind of your middle of your regime switching between I'm worried about the market high volatility to okay, things are a bit more normal. So we're not
Yeah.
quite in high normal zone. we're right about there, but the curve has flattened out. So I think there's definitely less concern than there was. Although overall, the market is still like the market is ready for if the administration announces a bunch of new tariffs tomorrow. The market is ready to get back to being, you know, concerned and selling off and whatever. Like that's kind of what I'm seeing here,
Have
but
no
not as
fear.
much.
The
We're not in.
uncertainty will come right back, I feel like,
It'll
right?
come right back, but, but right now we're more of just in a risky market rather than an uncertain market. So it's definitely
Yeah.
better. And again, I'm wondering if maybe investors are kind of getting used to the back and forth of tariffs, because I think that's more than anything. That's what's driving the concern now, just because they can be recessionary, they can be inflationary. We're not even really sure, because it's been, what, 100 years, 120 years since like the last time we've kind of had an environment like this in the US. So no one's really sure necessarily how things are going to react. So I think that's why we're seeing this bouncing between kind of risk and uncertainty now.
Yeah, yeah. No, that's super helpful, Jay. That's something that I'm sure a lot of listeners have probably heard of, but have never really understood. It's a really good way of illustrating. I appreciate you bringing a couple of these charts with you. I'd love to ask you this. I mean, one of the biggest changes structurally in the options market, I mean, arguably in history, but certainly in the last couple of years, is the introduction of the 0 days to expiration options, right? Which are now, from my understanding, I mean, the most liquid or the most heavily traded part of the options market.
Yep.
How does the introduction of 0 DTE options and certainly the proliferation of them, how does that impact? Does it impact things like the VIX, things like the term structure of the VIX futures, or is it sort of a separate thing? Because some have speculated that the VIX may be different now because now you have this big chunk of the options market doing a different thing. Has that changed your understanding or your use of any of these indicators, or not so much?
That's a great question. I've actually been asked this. I actually got asked this at the Money Show too. It's an interesting question that I've been pondering a lot, and I think it's kind of both yes and no to some extent. The VIX is based on 30-day implied volatility. So
right,
as long as you're getting the action in the 30-day options, whatever happens to be in the SPX, then that's going to really drive the calculation. So to some extent, no, right? But then on the other hand, right, there are, people or more like, firms that have, let's say, gone to hedging using 0 DTE. They found maybe more efficiency of, instead of putting on a trade every month, literally doing it every day and letting it expire, like maybe more bang for their buck or whatever. They've done the math, of course, and realized. So to that extent, like, that may mean that you're not getting as much data going into the VIX as there used to be. But
yeah,
I don't really think it's changed. It's changed other things, right? It's changed, definitely where retail traders are playing. They're definitely playing much more at the short end of the curve. Like now people consider 30 days long, like the long
term,
end, right?
The new leagues,
and
right, are 30 days out.
which is funny. Yeah, I mean, so which used to be is the shortest term you could trade. Like weeklies have only really gotten popular in the last 10, 15 years, right? So, so I think the impact is still developing, but I don't really feel it. It's not. It's more. I guess it's more. It's definitely impacting volatility on a very short term level, right? But when we're looking at the VIX, I don't think we see that. I think there might be other measures that show that a bit more, like more, obviously more specific to the different instruments. It's probably. Well, you don't have 0 D. We'll have to see. We don't have 0 DTE in single stocks yet, but I'm sure that'll happen at some point, and that
Only a
might be
matter of
another way.
time, I feel like, right?
Right.
So one final question, Jay. This has been awesome, and I really appreciate you spending some time on volatility, which I think is a real area where people stand to learn a lot more, and it's become more and more important, I feel like, to understand the current market environment. So based on everything we talked about, based on this sort of change in volatility, based on the VIX sort of around 20 at the moment as we're recording this, what does that leave you when you're looking at the S&P 500? You're looking at stocks with the major averages down 10% or so in the last week. Now we're getting a bounce during Fed week here. Sort of apply everything we've talked about to what you're seeing in the markets now. Do you generally see reasons to be optimistic? How do you approach, or how do you play a market like this using options? What would you say to that?
Yeah, and that's it's an excellent question that it's kind of saying, all right, what's your prognosis, and I don't really know, but I'll say that it's because this administration is very volatility inducing, right? With again, particularly with the tariffs, but
Yeah.
I would say that things are certainly being. I think investors adapt relatively quickly, right? And I think that as much as I would say, like as someone who has a background in economics, like I don't agree with tariffs. I don't think they make sense for anybody, but I also don't think they're probably as big as a deal as people are making them out to seem. You actually run the numbers on it, and it's much smaller than what it's like. You hear huge numbers like 25%, and then you look at it. All right, well, it might be a couple bucks here and a couple bucks there. Now, of course, that's a huge amount when you're doing it on an international scale of billions of dollars, but it's probably being overblown a little bit. But I think maybe some of the federal employees losing jobs might end up actually being the issue that could maybe push us into more of a recessionary environment. So I'm a little bit worried about that, and that remains to be seen. So I'm kind of cautiously optimistic, since we've seen things come down a little bit, that I bullish kind of for the rest of the year overall, but with a hedge in place, right? So
I noted it was bullish. It was posed as a question almost, Jay, which I love. That is a cautious bull if I've ever heard one. That was well done, well performed right there.
Thanks, thank you. But yeah, so I'm kind of like a hedged bull basically right now.
That's right. No, this was a lot of fun, Jay. I can't thank you enough. I mean, this is a real pleasure and being able to ask someone like you with the experience that you've had, and again, focusing on educating options traders and investors to understand things like volatility. I really appreciate you spending some time with our audience and helping them understand things a little bit better. Where can we point people to learn more about you and your work and what you're doing these days?
You can always hit me up on X there at Jay Soloff, Investors Alley, NetPicks, couple companies I do work for. You can check those out. I'm I'm around. Come see me at the Money Show, whatever.
Yeah, and I should make a point. You and I last saw each other about a month ago, I guess, right? A couple of weeks ago in Las Vegas at the Money Show. And thanks again for swinging by and saying hello. It's good to see you there and others. So I hope our paths cross again at the next one. But in the meantime, listen, Jay, thanks for coming by. Thanks for sharing some charts with us, and we'll look forward to circling back later this year. All right.
Yeah. Thanks, David.
That was super fun to chat with Jay about volatility. And again, I really appreciated his points that, volatility is something a lot of options traders and certainly novice options traders, people just getting familiar with the options market, something you don't tend to, they don't tend to understand deeply enough. As I shared in my conversation with Jay, I remember the first time I met an options trader and I saw he was looking at and this was couple years ago, I was looking at a printout of volatility data and Greeks, which are all the different, sort of volatility-based measures that options traders use to understand the options chain or the different strike prices you have access to. And it just hit me that that was the game, was not analyzing things visually as much. It was analyzing volatility and looking for inconsistencies, looking where things might be mispriced relative to the potential opportunity. And I really appreciated Jay's description of the VIX, what it actually represents. I look at the VIX every single day, and until this conversation, I don't think I understand exactly what Jay was going to tell us about the meaning of the VIX, what the volatility really suggests, and how we can use the term structure in VIX futures, which talk about a really cool additional way of thinking about sort of forward-looking volatility expectations that the market is currently pricing in. A lot of fun talking with Jay, and again, you can find more information about Jay on socials. He's on X at Jay Soloff, as you saw earlier in the video if you're watching it there. So thanks again to Jay for sharing some time with us here today. So if this sort of discussion about the S&P 500, about volatility and its implications, if that was interesting to you and you want to have a better, more consistent routine to understand the changing landscape of the financial markets using the best practices of technical analysis and behavioral finance, if that's of interest, I hope our Market Misbehavior Premium members are something that you would consider. You can find more information at marketmisbehavior.com/premium. 3 great benefits of the premium membership. Number 1, you'll have full access to all of our premium member reports. Our weekly flight plan is our main report where we look back at the week that just occurred. What lessons did we learn? What key patterns and signals occurred? And then look forward at the week to come. What levels, patterns, and signals are we looking for in the days and weeks looking forward? Also, our monthly chart review where we apply our proprietary market trend model to a series of stocks and ETFs. Second benefit is you will also be able to access all of our virtual courses. Our main one is called Flight School Behavioral Investing, where we teach you all about behavioral biases, about technical analysis tools, and how to create a more consistent analytical and investing routine using those principles. Also, we have a brand new course we are hopefully releasing very soon called Flight School Technical Indicators, where we go through particular buy and sell signals and give you some actionable ideas there. Finally, you have access to our members-only community. It is a vibrant and growing community of like-minded investors navigating these markets together, asking questions and sharing insights. I'm in there every morning answering questions from our premium members, and I'd love to have one more premium member, you, asking questions as well. You can find all that information and as well as pricing on our website, marketmisbehavior.com/premium. Don't forget to use the code PODCAST for 30% off your first 12 months on any plan. That's it for today. For Market Misbehavior, I'm Dave Keller. Thanks so much for joining me here today on the podcast. Thanks again to Jay Soloff joining us, sharing some perspective on the VIX. Have a great evening, a great day, and remember, it's always a good time to own good charts.